Hey there, what's happening, my beautiful financiers in training? Welcome back to another episode of the Do Different Better show. We talk about wealth wisdom and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, CEO and founder of Social Impact Now, Connective Institute, and managing director of the Integrated Capital Fund. Thanks so much for joining me today. Last week, I broke down the mystery of the credit score, and I showed you how to turn yours into a powerful tool for financial success. Whether you're buying a house, you're getting a car loan, or even just setting up your utilities, your credit score impacts so much more than what you think. We dived into how the credit score affected your interest rates, your job application, and I shared some practical tips for improving and maintaining a healthy score. Today, we're diving into something you've probably heard whispered about at fancy cocktail parties, but never really understood, and that is hedge funds. Now, before you click away, you're like, oh, this is so boring. Elaine, why are you talking about hedge funds? Thinking hedge funds are just for Wall Street billionaires. I just want you to stay with me because that's not necessarily the truth. This episode is going to demystify hedge funds and show you how they really work. No fancy finance degree required. Ready? Let's jump in. All right. So what the heck is a hedge fund? Picture this. A hedge fund is like a VIP investment club. It's a pooled investment. But unlike your typical mutual fund or ETF, and we've done shows on both of those, hedge funds are for the big players, the ones who can handle a little bit more risk and love making high stakes bets. I often call finance sometimes, it's just like approved gambling, right? You're making a lot of guesses based on a lot of good information and taking some calculated risk, like when you're playing poker, right? They aim to generate absolute returns, meaning they try to make money whether the market goes up or the market goes down or if the market goes sideways. Hedge fund managers use all kinds of strategies to maximize returns and minimize risk. Making money off of the money. The cool part is they're not restricted to just buying stocks. They use things like short selling, derivatives, and leverage to get creative with their strategies. So you'll often hear me talk about the movie The Big Short. This is another good correlation to that film. Hedge funds are talked a lot about in that film. And so if you want to augment understanding what happened in that movie, this is going to be a really great episode. But here's a fun fact. The term hedge comes from the idea of hedging your bets. Imagine you're placing a risky bet, but you also put some money on the opposite outcome to protect yourself. That's basically what hedge funds try to do. They want to reduce the risk while still going after big profits. Playing it cool, but keeping an eye on the big prize. Now, let's quickly take a stroll down history lane and talk about how hedge funds actually got started. In the 1940s, a guy named Alfred Winslow Jones, who was a sociologist and a financial journalist, came up with this brilliant idea. Some would question whether it's brilliant or not. He created the first hedge fund in 1949 by using a combination of long positions, buying stocks he thought would go up, and short positions, selling stocks he thought would go down. He was hedging his risk. See, that's how the name came about. Jones' approach worked so well, others started taking notice. Hedge funds started popping up over the decades. They evolved into massive, high-powered vehicles for wealth, but here's the kicker. Hedge funds are not available to just anyone. You typically need to be an accredited investor, and we've talked about what an accredited investor is on previous episodes, meaning you have to have a certain level of income or net worth. That's why they're often seen as exclusive. Fast forward to today, and hedge funds have a huge influence on global markets, from stocks to currencies to commodities. Hedge funds can bet on anything and influence almost every corner of the financial world, which is why it's really to at least have some notion of understanding of how they impact your financial positions. They've become a key player in how markets move, and because of their size and power, they can sometimes even move the market themselves. Crazy, right? I'm a really big fan of the television show, HBO special Billions, where the main character, the main protagonist or antagonist, depending on how you want to characterize him, is a hedge fund manager. He starts his own hedge fund, which has billions and billions of dollars of assets under management. Now that you've got a feel for what hedge funds are and where they come from, let's get into the different types of hedge funds there are, because they don't all work the same. Hedge funds use a wide range of strategies depending on what the manager thinks will make the most money. Here are the four main types that you need to know about. 1, long and short equity hedge funds. This is the most common strategy. Basically, the hedge fund buys or goes long on stocks they think will rise in the value and shorts or sells stocks they expect to drop. This way, they can profit no matter what happens in the market as long as their bets are right. Think of it as a way to play both sides against the middle. Number 2, event-driven hedge funds. Now, these funds thrive on corporate events. Think mergers, acquisitions, bankruptcies, big moves in the corporate world. The idea here is to make money by predicting how these events will affect stock prices. It's kind of like betting on whether your favorite celebrity couple is going to get married or break up. These hedge fund managers are constantly tracking the latest business gossip, but instead of reading tabloids, they're studying financial reports, right? 3, macro hedge funds. Macro hedge funds take things global. These funds bet on broad economic trends, think currency movements, interest rates, or even national policy changes, even presidential changes or coups in particular countries. A macro fund might bet on the dollar weakening or the particular currency weakening against the euro, or the price of oil is skyrocketing. It's about making educated guesses on world events based on cycles, based on algorithms, based on just historical information. And 4, relative value hedge funds. Last but not least, relative value hedge funds look at pricing differences between related securities. For example, they might see that 2 stocks in the same industry are valued differently and bet that the gap will close. It's like spotting a sale at 2 different stores for the same pair of sneakers. Eventually, the prices are going to balance out. These hedge funds capitalize on those little inefficiencies. So, I know this is really a big, broad, heady topic to really kind of get into, but I think it's really valuable and important. I think sometimes we don't even understand how we do this in our own daily life. We're hedging all the time. So just think about the hedging that you do, like the shoe sale example that I just gave you. We're always looking for where are the opportunities? Where are the advantages? Where do we think that something's going to fall apart and we avoid it? Or we want to be like, hey, I know this person isn't doing a good job. I'm going to position myself well to take over that job because it looks like this person is not performing well and they are performing themselves out of a job that I actually want. That's a hedge, right? So just think about this. I know sometimes finance can feel like and sound like and look like that it's this thing that lives way out in this other universe that you have no access to. And that's the reason why I'm doing this show. These things are actually part and based off of how we actually already live our lives, right? We are always hedging. We're hedging whether or not somebody is going to stop at the light or not stop at the light or run through the yellow light, right? We're always thinking about, can I make it before that person? Or we're hedging with our kids, right? This happens a lot with our kids and our family. We're like, hey, you know what? This person can reliably be consistently late to an event. So what I'm going to do is I'm going to tell them to come 30 minutes. I'm going to tell them that the time of the meeting is 30 minutes earlier because I know that they're always 30 minutes late. That's a hedge, right? So once again, I just want you to start drawing on these concepts and these terms are just taking what you normally do in regular life, and now it's set into a financial system. So I'm hoping that this is really kind of breaking down the demystifying for you how these things actually work and how they're not really these big brain things that you can never conceptually understand. But if you can kind of look at, how do I hedge things in my own personal life? How do I hedge my partner because of their certain behaviors or characteristics or idiosyncrasies? How do I hedge people at work using the same thing? We're doing the same thing that we normally do with people and pricing and budgeting, to actually now moving into just bigger, more zeros behind the numbers. That's all. More commas and more zeros. That's all that we're doing, right? So what's my call to action, you might be asking? You're like, hey, Elaine, I'm not an accredited investor. That's okay. That's okay. Remember, you are starting your investing journey. So I just want to make sure that you're getting information and you can start to think about and pick and choose where you want to go in your financial journey. But if you've ever wondered about hedge funds or even dreamed of cracking the code on high stakes investing, I want you to go ahead and hit the subscribe button and don't miss out on our next episode of Do Different Better. But always, I want you to share this episode with your friends. But in the next segment, we're going to be breaking down hedge funds even more and how it shows up in your regular life. So let's keep growing and see me back after the break, where I show you how to do different better. Welcome back, everyone, to the Do Different Better show. I'm your host, Elaine Rasmussen. And in the first segment, we covered the basics of hedge funds, what they are and the different strategies they use to make money. Now let's dive deeper into how hedge funds actually operate. We're talking about who's behind the curtain, pulling all the strings. How do they make these big money decisions? And more importantly, how do they get paid? Spoiler alert, it is not a small paycheck, okay? So let's jump into it. Who runs hedge funds? Meet the hedge fund manager. These are the masterminds who make the investment decisions and manage the day-to-day operations of a hedge fund. Hedge fund managers typically come from finance backgrounds. Think Wall Street traders, financial analysts, or investment bankers. These folks are some of the sharpest minds in the financial world, known for their risk-taking ability and their knack for seeing opportunities where others don't. There's another part of hedge funds that I don't think gets really talked about. And if you ever watch the show Billions, they really get into this aspect, which is the analytics and the data and the algorithms that are built to help make predictions. There are even smarter people who will build algorithms, which are highly complicated mathematical equations that can take historical information and make predictions based on historical information. And by feeding it current information, like, hey, this is where the stock has been going, and there's going to be a new CEO that's going to be coming in 6 months. There's going to be a legislative ban that's going to be coming up, or there might be a legislative restriction that's going to be lifted. All that information gets put into what's called an algorithm, and the algorithm then spits out to the analyst possible opportunities that are then taken to the actual hedge fund managers of the different accounts for them to make decisions on whether they're on board with those bets or not. Right? But that doesn't take away from the hedge fund managers who might do it the old school way of doing their own research. But I think it's valuable to know that there's a lot of supercomputing that is now behind not only the banking industry at large, but particularly hedge funds that help them predict some of these or give them ideas of predictions of where they might be thinking about how to invest. But the algorithms are also helping them think about how to diversify and maximize the diversification within their portfolio based on these opportunities that may be presenting themselves. But let's not forget the other side of the equation. That is the actual investors. Who can actually put money into a hedge fund? Well, it's not your everyday investor. Hedge funds typically require what's called an accredited investor. Those are folks who have a high net worth or significant income. We're talking about individuals who have a net worth of $1 million or an annual income of $200,000 or $300,000 as a married couple. So I wouldn't say it's exclusive. I think we're on trend to see more and more people accessing those income levels, which then make these opportunities actually far more pliable, right? When you think about what are the salaries on, particularly on the coast, a $200,000 salary, particularly if you're at a director level or C-suite level, is actually not unrealistic, right? So there's quite a few people who are now falling into this accredited investor category than in years and decades past, right? Here's a fun fact. Did you know that less than 10% of American households qualify to invest in hedge funds due to their financial requirements? Hedge funds are built for high rollers, and they're often considered a playground for the rich and famous. But as I said, as more people are achieving these sort of salary incomes just because of the cost of living, the rule of accredited investing, which is set by the IRS, has not changed in a number of years, maybe even over a decade. And so now it is making it more accessible for people who are on their way to be high net worth earners to be able to access some of these investing opportunities. So this is what I mean by it's not just for the rich and famous anymore, as more people are moving into this type of income bracket, particularly on the East Coast and the West Coast and Texas. So number two, now let's talk about hedge fund strategies, right? And how the hedge funds make their money. Hedge funds are famous for their diverse and sometimes aggressive strategies. So here are a few of the most common strategies that they use. The first one is leverage. Leverage is like borrowing money to make your bet bigger. Let's say you want to invest $1,000, but you borrow another $9,000. Now you've got $10,000 to invest. If the investment goes well, your return is much higher than it would be if you only used your original $1,000. But also, if the investment tanks, well, you're now on the hook for a lot more money than the original investment. Leverage amplifies both the potential for losses and the potential for gains. Number two, short selling. Short selling is another popular strategy. Instead of buying a stock and hoping that the price will go up, you're betting the stock will go down. Hedge funds borrow shares and sell them at the current price, and then wait for the price to drop. Once it does, they buy the shares back at the lower price, return them to the lender and pocket the difference. It's risky because if the stock price increases instead of dropping, the hedge fund could lose big money. And once again, hedge funds are not always using their own money. They're using investors' money, which is possibly you. The third thing that they do, and this is talked about a lot in the movie The Big Short, derivatives. These are complex financial products that hedge funds use to hedge risk and amplify their potential returns. They're called derivatives because they derive their value from other assets like stocks and bonds and currencies. Think of them as a contract between two parties that depends on the future performance of an asset. Hedge funds love derivatives because they allow for creative strategies, sometimes too creative if you ask me. And they've been called into question many, many times. And once again, if you watch the movie Billion, you'll see some of the hedge fund managers are scrupulously watched by the main protagonist, which is the district attorney, which happens to be Paul Giamatti, who I absolutely love and adore. Hedge funds don't just stick to one strategy either. They are incredibly flexible and adjust their strategies based on market conditions. For example, if the stock market is doing well, they might lean into long position, meaning that they're buying stocks that they expect to go up. But if things are a little rocky, they might short the market or use derivatives to protect their portfolio. Hedge fund managers are constantly reading the tea leaves and adjusting their plays to maximize returns, like minimizing risk. So if you want to think about kind of how does a hedge fund manager work, it's kind of like a basketball coach on the sideline trying to navigate the game in real time. Like, what is going to be the play that needs to be to get you to the win? What is the play that you want to get get the number of points that you want to get to by the end of that quarter, right? Same thing with other kinds of coaches, right? A soccer coach. what are those plays that you want to get on the board to get you the most advantageous position. But you're constantly readjusting based on what's happening on injuries, with your players, what's happening with injuries on the other team, what's happening with the plays that they're pulling on the other team. So a hedge fund manager is kind of doing the same thing. They've got maybe 5 to 10 plates running at the same time, and they're trying to like tiptoe through the tulips to try to make sure that they are maximizing profit for their investors across their portfolio. So now let's get into the part where hedge funds really differentiate themselves from other investment vehicles, and that is the fees. The fee structure of a hedge fund is notorious. It's typically called 2 and 20 model. And it's funny, I was just sitting on a call and I was at a finance meeting the other day, and they were talking about a 1 and 30. So we're going to talk about what all that means. And here's what it actually looks like. So the 2 stands for a 2% management fee. Hedge funds typically charge a 2% management fee on the portfolio investments that they're managing. This fee is based on the total assets under management, and we've talked about this before, AUM, and it's paid regardless of whether the hedge fund makes money. So if the hedge fund is managing $1 billion, that's $20 million in management fees right off the top, no matter what happens, right? Then there's a performance fee. The second part of this fee structure is where the managers make their big bucks. It is the 20% performance fee. This fee is based on the profits that the hedge fund generates. So if the hedge fund makes $100 million in profits, 20% of that is $20 million. That goes to the manager. Hedge fund managers are incentivized to take risks because the bigger the profit, the bigger the cut. Now, some might say that is highly problematic because it really relies on extractive practices, and that's a fair statement. I'm just here to inform you about what this universe is and how it works. There are complications and there are critiques that can be made of everything that I'm going to be providing for you, and it is up to you to really kind of search your conscience of how you want to set up your financial system and your financial portfolio. If you are not interested in hedge funds because they don't align with the values that you want outlined in your portfolio, that is absolutely fine. But I'm doing my job by wanting to make sure that you understand what they are, how they work, and what are some of those values-based questions that you may want to have. Now, there is this trend that's happening in hedge funds around even environmental funds or environmental awareness or ESG, which is environmental, social, and governance priorities or values around some of these funds, that these values are implemented, or the perspective of how different client or companies are bought and sold within these kinds of these ESG portfolios. We'll have another show on ESG and other sites of mission-focused investing, gender investing. We'll talk all about that and how that plays into some of these other characteristics. But let's get back to the conversation at hand, which is hedge funds, right? So on the one hand, the fee structure, this 2 and 20 fee structure motivates hedge fund managers to deliver results because they're getting the 20% off of what they're making for their clients. On the other hand, these fees can eat into the returns of investors. Imagine earning 10% on your investment, but after the 2 and 20 fees, you're left with closer 6 to 7%. That's a big difference, especially when you're dealing with millions of dollars. Now, you're going to have to pay fees somewhere, somehow. So for some, the case could be made of, well, if I put my money in the market, I'm going to be making 5 to 8% anyways. So, but some people like the universe and how the mechanisms of hedge funds work over the high volatility of stock pricing or buying stocks, which you have to be your own hedge fund manager of mitigating some of the downstrokes of some of the stocks you may have in your portfolio, right? So what are the pros? You've got top tier managers with skin in the game who are highly motivated to perform. The cons, the high fees can reduce your net gains and sometimes push managers to take on more risk than you might be comfortable with. So there you have it. Whew, that was a lot. I know that was a lot. That was a lot. That was a lot to even say. So I can imagine it's a lot to take in. But I want you to just go back and keep listening to this episode because I think there's some really good stuff there for you to start and see and understand how all of these things start to work. And as you watch films like The Big Short and you watch television shows like Billions, hopefully it's giving you a better context for what's happening because I find it just fascinating to understand how all of these mechanisms work together and how can we get this information into the hands of more people. So there you have it. Hedge funds are super, super powerful, high stakes financial vehicles that are run by some of the smartest minds in finance, but they can come at a cost, literally. Whether it's fees, whether it's the risk, or whether it's exclusivity, hedge funds are not for everyone. But for those who qualify and can stomach the volatility, hedge funds offer opportunities for massive gains. Okay, listeners, I want you to take a step back and think, do hedge funds sound like something that would fit in your investment style or portfolio? Could you see yourself taking the risk for the potential reward? Whether it's hedge funds or not, make sure you're making smart, informed decisions. And if you're ready to dive deeper into the world of high risk, high reward investing, hit the subscribe button and stick around for the next segment where we're going to talk about more pros and cons of hedge funds and whether or not it may or may not be right for you. Can't wait to see you after the break. You've been listening to Do Different Better. I'm your host, Elaine Rasmussen, and I will see you in just a little bit. Welcome back to the Do Different Better show. I'm your host, Elaine Rasmussen. So far, we've walked through the basics of hedge funds and how they operate. But you know what they say, high reward often comes with high risk. Hedge funds are no exception. It looks like maybe Skittles might be coming for a visit. You're going to make your appearance on the show today. We've got Skittles joining us, our special guest today joining us. So what were we talking about? But you know what they say, high reward often comes with high risk. Hedge funds are no exceptions. And in this segment, we are diving into the risks you need to know before even considering hedge fund investing. We'll take a look at the regulations or lack thereof, and finally help you figure out if hedge funds are right for you. So let's get into it. So as I mentioned before, hedge funds are not on everybody's investing Rolodex, right? We already talked about some of the exclusivity, but also how much you really have to like make it worth your while, right? But the rewards can be super high, but the risks are equally large. So I'm going to break it down for you. So first, let's talk about high risk, high reward. Hedge funds are known for their aggressive strategies like leveraging money. They don't have on betting on the stocks that will fail. When these strategies pay off, the rewards can be massive, even double-digit or even triple-digit returns in some cases. However, when they don't, it can really be a disaster. You're taking significant losses that could wipe out large portions of your investment portfolio. Next is illiquidity. That is illiquidity. So think of liquidity as something being very liquid. And in finance term, liquid means that you can get your money out, your cash, relatively quickly. Illiquid is something different. Now, that can be a huge deal breaker for people. Illiquidity. Unlike stocks or mutual funds that you can sell on a whim, hedge funds often lock up your money for long periods of time, sometimes years. This means even if you need to access your cash, you may not be able to. Most hedge funds have something called a lockup period, which restricts when investors can pull their money out. And trust me, that's something you don't want to overlook if liquidity is important to you, or that you only put in your part of money from your portfolio that you can afford to be illiquid, right? Which means you can't get the cash out relatively quickly. Finally, there are leverages and losses. And we've talked about leverage before, but let me spell it out again. Leverage is when the hedge fund borrows money to increase their potential returns. but it's a double-edged sword. When things go well, leverage can multiply your gains, but when things go south, it can amplify losses big time. Imagine betting 10 times your original amount and watching the market move against you. That's a risk that most traditional investors would not take. And particularly if you're new to investing, I've got Skittles hair all over me. If you're new to investing, definitely this is not the place you want to start. Hedge funds are not for the faint at heart. It is not for that person who's going to be checking their account every single minute. These risks are real. And while the rewards are tempting, you have got to be prepared for the potential downside. You may have heard, people, hedge managers, taking their own lives. You may have heard, businesses closing. We've seen there's been several movies. I think The Wolf of Wall Street, of people being taken in and they really could not afford those losses. And so these are the things that you want to be thinking about. Even if you get to a certain point where you can afford it, is that where you want to be? Particularly depending on where you are in your life. As you get older in your life, you want to be a little bit more conservative because you don't necessarily have the time to make up for any losses that you may experience. You don't have the time length because it does take time to build up investments over your portfolio value. And so if you're later on in your years, you have a shorter amount of time to rebuild your portfolio value. And so that's why as you get older, typically it's recommended that you have a more conservative portfolio because you need to maintain and preserve that money for your expenses and for your living and any other things that any other things you might have be going on. If you're funding a trust for your children or grandchildren, anything like that, right? So number 2, now we're going to talk about regulations. So you may have heard that hedge funds aren't as heavily regulated as other types of investments like mutual funds. And you'd be right. And let me explain. So here's an overview of the regulation. Hedge funds operate with a lot less oversight compared to mutual funds, stocks, and ETFs. They're mostly regulated by the Securities Exchange Commission, or SEC. You may have heard that term kicked around a lot, particularly if you watch finance shows, you hear about the SEC. That is the United States governing body around stocks and any sort of security, meaning a security is something where money has been exchanged for some kind of value, right? That's a security. But here's the catch. Since hedge funds only deal with accredited investors, meaning people with high net worth, they don't have to follow as many rules. The federal thinking or philosophy is that wealthy investors don't need as much protection as the average person because they can afford to take on bigger risk. Now, I would argue whether or not that's true, but these are our definitions by federal statute. We don't always have to agree with them. We don't always have to think they're right. I would argue, as somebody who interfaces with wealthy people a lot, I don't think that wealthy people are necessarily smarter than other people. They have access to things that people who don't have wealth have access to, particularly information, resources, and opportunities, but that does not necessarily make them smarter. They are sometimes in a position to hire smart people, which makes them look smart. But once again, this isn't to say that wealthy people are stupid. This is also not to say that non-wealthy people are stupid. This is about that our financial philosophy that undergirds our financial system are intelligent or have a higher level of intellect and understanding these concepts than people who don't. Particularly with the advent of the internet, there's so much information you can learn on the internet. So both of these groups, one is not necessarily more smart than the other, which is my point. So why less regulations? With fewer regulations, hedge funds can make and use riskier strategies like short selling, betting against the market, that mutual funds and other financial products aren't allowed to touch. It's both a blessing and a curse. On the one hand, hedge fund managers have more freedom to chase big returns. On the other hand, less oversight means that there's a bigger chance for things to go wrong. So think back to the 2008 financial crisis, when a lot of hedge funds got into a lot of hot water because of the bets that they were making. Literally, the crisis was one big bet on the housing market as well as bets against the housing market, causing the whole thing to collapse and leading to the financial crisis of 2008 through, I would say, 2010, 2012, depending on where you were living. Finally, are some recent regulatory efforts. In recent years, there have been some efforts to be made to increase transparency in the hedge fund world. After the financial crisis, like the one in 2008, regulators began pushing for more disclosures and closer scrutiny of these funds. Disclosures are what is the information that you must tell all investors about the opportunities, but also the risk of this particular financial instrument, right? Those are called disclosures. A lot of times the disclosures are written in very, very small writing that are requiring your signature to say that you read. I encourage you to read them, right? Know what is in them. And sometimes you may need a dictionary alongside, but you can also, if you're signing a disclosure, you're working with a financial institution, sit and make that person who is putting that disclosure in front of you to explain to you what that disclosure says in plain language. Okay. So once again, just because you get something to sign does not mean you just sign it right away. Find out what you are signing. Do not sign anything without reading it first. Okay. Anyway, let's get back on track. What's the goal? Make sure that you're not taking reckless risk that could ripple through the broader economy. But even with more oversight, hedge funds are still largely in a class of their own when it comes to regulations. So, what does that mean for you? If you're considering hedge funds, know that you're stepping into a world with few safety nets. That's why doing your own research and understanding the risk are so critical. So here's the $1 million question. Is hedge fund investing right for you? Let's hopefully help you figure that out, and with a few questions that I want you to consider. And I think these are good questions regardless of any investment that you're thinking about making, right? How much can you afford to risk? Hedge funds are high risk, high reward. So you need to ask yourself if you're comfortable with that level of risk. If losing a big chunk of your investment would cause you major stress or put you into financial stress or put you into a desperate situation, then hedge funds may not be the best choice for you, right? And if you find that you maybe are an adrenaline junkie, the case could be made that hedge funds aren't for you as well, because these could feed your adrenaline junkie, which could then cause you to possibly make some rash decisions that aren't in your financial best interest. So the second one is liquidity. Remember that a hedge fund often locks up your money for months, even years, right? If you need easy access to your cash, you'll want to steer clear of a hedge fund. Liquidity is a key factor for a lot of investors, and hedge funds typically don't offer that much of it, right? There's not a lot of liquidity. There might be what's called a redemption period, meaning even after the lockup period is ended, there might be a time period that you still don't have access to it. So let's say your lockup period is 12 months. There might be a period in between there that's like, well, we can still call it for another 90 days. So these should be outlined in the disclosures, but you want to make sure that you are clear in understanding all of these things, right? So the last thing is, and this is a big one, every hedge fund has its own strategy. Some focus on short selling. Others might bet on macroeconomic trends, so things that are happening worldwide. So one of the things that we saw with COVID was shipments being stuck in customs, shipments being stuck in ports, or things not leaving ports to get to where they needed to go. Those are macroeconomic trends that then impacted different specific economies like retail, right? Retail was dramatically impacted, which then actually drove local buying, right? Local producing, local buying. That is a macroeconomic trend that a hedge fund might look at like, oh, I'm going to start investing in specialty retail gourmet food stores, because during the height of the pandemic, we weren't getting some of those commoditized foods shipped to us in a timely manner. So it forced people to like buy super, super local. So that then may be a trend that a hedge fund might leverage that wave to make some investments in a variety of different private markets or other market opportunities or financial instruments. So, and still others might take a deep dive into derivatives, but making sure that your strategy and your financial goals and your risk tolerance are all in alignment. But more often than not, if you're working on or using or leveraging hedge funds, you're going to be working with an investment manager. I don't know that I would recommend doing this on your own in any way, shape, form, or fashion, unless you have a finance degree. And even then, depending on what your finance degree is, you may not have enough information to do this on your own. So I would definitely encourage you to work with somebody. If you're in a hedge fund, more than likely you're working with an investment or wealth manager or wealth advisor office. And they should be talking through with you all of the risk and all of the opportunities. And so you should not be doing this alone. But if the manager's approach doesn't feel right to you, trust your gut and move on. There are other financial gains opportunities and other financial instruments. You do not have to go into a hedge fund, okay? So, but if you're seriously considering hedge funds, I can't stress enough talking to an advisor. They can really help you understand whether a hedge fund is a good fit for you and your financial goals and your financial position, your risk tolerance, and your overall portfolio in this moment. So your wealth financial advisor might say, hey, hedge funds are a great opportunity. I just don't think they're a great opportunity for right now. If we can get your portfolio to X amount of dollars, that's the point that I want to revisit us talking about whether or not we leverage the hedge funds as a financial instrument to get you more financial gains. So your financial advisor should be prompting you, but if they're not, very similar to a doctor, ask them about hedge funds. Say, hey, what's your philosophy on hedge funds? Even if you're not necessarily interested in investing in hedge funds today, ask your financial advisor if you currently have one or when you bring one on, hey, tell me about that. What does it look like? What's your philosophy? How do you make decisions? So now you can start that journey before you even start investing into hedge funds. So there you have it. Hedge funds are powerful investment vehicles, but they're not for everyone. They come at high risk, less liquidity, fewer regulations, but they can offer the potential for big rewards if you're willing to play the game. But remember, hedge funds aren't a set it and forget it type of investment. You need to be engaged, you need to be informed and comfortable with the potential for losses. If you're intrigued about hedge funds but want to learn more before diving in, I really encourage you to consult with a financial advisor who can guide you through this really complex world. And if hedge funds aren't for you, that's okay too. There are plenty of other investment strategies that are out there that I'm going to be talking about that can help you grow your wealth. So I want to thank you for tuning into another episode of the Do Different Better Show. I'm your host, Elaine Rasmussen. I hope you're feeling more curious about the high stakes game of hedge fund investing. We've covered long and short strategies to the famous and infamous 2 and 20 fee structure. I broke down some of the key strategies, risk and rewards of this elite investment club. Not only that, but I talked about whether hedge funds are right for you and how to make smart decisions when it comes to these high risk, high reward opportunities. So join me next week for another action-packed finance episode with tools, tips, and resources to take your financial freedom journey to the next level. But before you go, make sure you subscribe to this show and leave a review if you're loving what you're hearing. And don't forget to share this podcast with your friends. Let me know what you think of the show. Please, we love comments. So tell us how this show has helped you. If there's a money or finance question you have, or if there's someone you want me to interview, hit me up on LinkedIn or Instagram at Do Better with Elaine. Until next time, stay empowered, stay focused, and I will see you next week when I show you how to do different better.